If you're sitting on a deposit right now, waiting for interest rates to drop before you buy your next investment property, I want to walk you through something. I'm seeing a lot of investors get pre-approvals, be ready to go, and then sit on the fence. 90 days later, they're back again asking for an extension. And the property that they were looking at has now increased in price by about $30,000. The market didn't wait for them. Right now, I'm working with investors every day who are asking the same question. Should I buy now or should I wait? So I'm going to break down what's actually happening with interest rates and why waiting might be costing you more than you realize. Let's start with interest rates. Based on RBA's recent meeting and the narrative coming out of them, the likelihood of further rate cuts is limited. The RBA is watching unemployment, inflation, and importantly, the property market. Right now, the market's running hot. First home buyer schemes are active, low deposit initiatives are picking up, immigration is strong, the rental demand is high, and many markets are forecasting growth between 7 to 15% over the next year. With strong demand and limited supply, they're not in a rush to cut rates anytime soon. So, most brokers are working on the assumption that significant rate cuts are unlikely in the short term. If we get one, great, but we're not planning around it. Now, say the RBA increases the rate by 0.25%. What does that actually do for you? A 0.25% rate increase generally decreases your borrowing power between 3 to 6%. So if you can borrow $1 million today, after a rate increase, your borrowing power might reduce between $940,000 to $970,000. But here's the real question. What are you giving up while you wait for the rates to change? When you sit on the sidelines, you're giving up three main things. Number one, capital growth. In the current market, many areas are seeing between 7 to 10% growth per year. If you wait 12 months to buy a $600,000 property and it grows by 8%, that property is now worth $648,000. You've missed out on $48,000 of potential equity. Number two, rental income. Every month you don't own that investment property is a month you're not collecting rent. If it rents for $500 a week, that's $26,000 a year in rental income you're not receiving. Over 12 months of waiting, that's $26,000 that could have been offsetting your holding costs and building your cash position. Number three, tax benefits. If it's a new property, you're missing out on depreciation and on claiming other tax deductions. For high-income investors, these deductions can make quite a significant difference in your overall tax liability. When you add those three things up, the cost of waiting looks more expensive than a slightly higher interest rate. There's another piece that doesn't get talked about enough: inflation. Let's say you borrow $600,000 today to buy an investment property. That feels like a lot of debt. But with the average inflation rate at around 3% per year, that $600,000 in 10 years' time feels closer to $440,000. And in 20 years' time, it feels closer to $330,000. Meanwhile, your income is hopefully growing by 3 to 4% per year. Rents are rising, property values are rising, and your debt stays the same in nominal terms, which means that it's shrinking in real terms. When you buy property, you're locking in today's debt with tomorrow's dollars. Over time, that debt becomes easier to service as your income grows and inflation does its work, while the cash sitting in your account is quietly losing its purchasing power every year. And for the investor saying, I'd love to buy right now, but I don't have the 20% deposit yet, that's why I'm waiting, my advice would be this: you don't necessarily need 20%. If you've got 5% plus stamp duty, you may be able to buy. There are lenders out there who will give you 90% borrowing without lender's mortgage insurance. Yes, the rates are 1 to 2% higher, but you'd need to weigh that against the growth. On a $500,000 loan, paying 1 to 2% more in interest works out to be an extra $5,000 to $10,000. But if that property grows by 7 to 10%, that's $35,000 to $50,000 in capital growth in that same year. As long as you can sustain the cash flow, the growth can outweigh the interest. Plus, once the property appreciates and equity is built up, you can often refinance to an 80% loan with sharper pricing. So that higher rate is usually just temporary. Some lenders are now offering a 40-year loan term to help manage repayments while you're at that higher rate. So, buy now or wait? The best time to buy property is when you are genuinely ready. You're ready when you've got at least 5 to 10% plus stamp duty, you've got consistent income and a stable cash flow, you can sustain repayments despite vacancies or a small rate rise, and you've got discipline to stick to the plan. If those boxes are ticked and you're just waiting for a rate cut, that may or may not come, that waiting has a real cost. And that cost compounds every month you sit on the sidelines. I'm not telling you to rush into something you're not ready for. Property is a long-term game, and the numbers have to work for your situation. If you want to understand your borrowing capacity right now and what different options look like at different deposit levels, I've left a link below to book a strategy call. We can look at your numbers and map out the clearest pathway forward. Otherwise, I'll see you in the next video.